The construction industry is a really scary place to be right now. There are companies going to liquidation left, right and centre. And it's scary because people just don't have control of their costs. They don't understand them. So often they're actually losing money. The leader needs to take responsibility for their business. And if they don't have a hold of their finances and understand it, they need to make sure they employ the right people that do. It's very easy for leaders of businesses to be out there schmoozing clients and going on golf days. But unless you've got a team in place and you know where your business is at, you know where your costs are at, then you're not leading anything. You're just basically business development. And what's the point in developing a business that's failing?
Welcome to Taking the Con Out of Construction, the straight-talking show that's changing the industry, one episode at a time. Small mistakes can cost big money, and even more in time. But a small investment in listening to this episode could help you avoid disputes, delays, and costly pitfalls, while giving you the know-how to stop problems before they start. Let's turn complexity into clarity and take the con out of construction.
Welcome to Season 2 of Taking the Con Out of Construction. We're kicking off by discussing the crucial topic of cash control, something every contractor, supplier and client feels the impact of. Michelle, I'm sure that in your extensive experience, this is something you've seen trip up even the most experienced of teams.
Yeah, the biggest issue, in my opinion, in the construction industry is cash. We've all heard of the term cash is king, but what does that actually mean? The problem in a lot of the companies that I work with, a lot of the projects that I work with that are in trouble, it's because people just don't have control of cash. Now, the amount of times I've had clients coming to me that are either subcontractors or main contractors, and when I first meet with them and we're doing a bit of exploration work, whether it be a first call or initial meeting, and they tell me they've got a turnover of £10 million and they're making 20% profit and they have no cash flow. Doesn't make any sense. And I don't get why that doesn't make sense to people, because if you've got a £10 million turnover and you're making 20% profit, that's £2 million a year profit. And the biggest thing is people don't understand the difference between overheads and profit, or markup, more importantly, and profit. I think it's really, really important to talk about cash and cash flow and money and how to make it in the construction industry. And I wanted to give some tips on where people go wrong and what the common issues on projects are when it comes to cash. Everyone's aware that there's a issue with payments in the industry, people complaining about 60-day, 90-day, 120-day payments, which is just not acceptable. Now, if you're working for the government, often on contracts with the MOD or NHS, a lot of the time they will specify that there's a 90-day payment process. If that's in your contract and you've agreed to that, then that's tough luck. But you need to obviously get things in place, which is probably a bit more specialist. If you're working on 90-day payment terms or further, you need to make sure that things are aligned properly. We've discussed the applications for payment. One of the things that you can help with your cash flow is to make sure that you are paying up to the payment date. So make sure that what the due date is and what it means in your contract is whether that's the payment date or the application date. So if you've got 90-day payments, what you should be doing is valuing up to, say, 60 days in advance. But that's a bit more specialist and you need to get advice on that. But also the things that people don't think about when they've got a 90-day payment process is actually that's additional costs. So if you're purchasing your materials, and that could be 120 days from the day that you've committed to the cost of those materials on day one that you ordered them, from that day, obviously you've got an application date, and depending on where that date is in your application period, obviously makes a difference. But ultimately, if you're talking about ordering materials and committing to materials on day one, and you're not going to get paid for those materials for a minimum of 90 days later, if not 120 days later, then how are you paying for those? Are they being paid for upfront, which is something you can negotiate in the contract? But if they're not, how are you paying for them? Are you paying for them in a 30-day period? Are you negotiating with your suppliers to have the same payment terms as you have? So 90 days, 120 days. Are you putting them on a credit card? If you're putting them on a credit card, then what are the interest charges associated with that credit card? Because that needs to be part of your costs. And therefore, that should be paid for by the client if that's what they're expecting. There's a difference between having an agreed 90-day payment term, which you are aware of or should be aware of, and you agree to or don't agree to at time of contract, and being paid in 90 days out of those terms. So I'm talking at this precise moment about 90 days payment terms that's been agreed from the offset as part of your contract. I'll talk about in a moment about late payers. That's a totally different scenario. So if you've agreed to 90-day payments, you need to make sure that when you're tendering for these projects, you should be made aware of the 90-day payment rule way before you're in contracts. It should be at tender stage. You should be allowing for that. But also, I would put that what I call below the line. It's explaining this is a cost to our business because of your payment terms, and offer them a reduction for better payment terms. Now, with the likes of the MOD, you're unlikely to get better payment terms because that's just how they work. But they need to be aware, and there's no difference in you saying, well, this is the interest charge for theoretically bankrolling your project for the 90 days waiting to get paid. And actually, you'd be surprised how many companies expect it. The amount of companies that don't do it is unbelievable. And obviously, it's dependent on the circumstances. I haven't worked for the MOD for 20 years, but that's what we did 20 years ago. So if you've got these elongated payment periods that you're aware of, you need to make sure that you're covering your costs, because one of the issues that people think they've got 20% profit, they don't. They're sending their jobs out to tender, they're getting their prices back, they're adding 20% of their tender costs, and they think they're making 20% overhead and profit. Now, that's just not how it works. Adding 20% to your tender cost. So say, for example, you're an MEP contractor. So you will be subbing out potentially, or you might have your own team, but there'll be parts that you're going to sub out. Say you've got 2,150, whatever number, electricians. You may have some specialist guys, you may have some maintenance team. Most companies that I've worked with wouldn't necessarily have, say, a public health team, or they wouldn't necessarily have BMS, internal BMS suppliers. So they might have a subcontractor with a BMS. They might subcontract out the fire alarm system. They might subcontract out the sprinkler systems. You've got this entire package. It's very rare, in my experience, that one company does all. So regardless of what level out, you're likely to be subcontracting something out. So yes, you probably understand your own costs, but obviously you need to be aware of what the budget is, what their program is, and how you've priced that properly from your QS department, estimating department, whatever department is pricing the work for you. But when you're sending out the specialist stuff, just adding 20% doesn't necessarily mean it's going to be 20%. One, because unless you've looked at their tender properly, compared it to what you're tendering for, had a look at their caveats, make sure you've got the same caveats, back-to-back systems, whether things have been added or omitted or whatever they may be. Adding 20% is only okay as a profit, providing the overheads associated with that element of work are included elsewhere. So if you've got your prelims, and this is a massive thing in a lot of companies, they don't understand the difference between prelims and overheads. So prelims include overheads, but ultimately when you're looking at your prelims, and I always recommend that people actually extract these out of their costs. A lot of contractors that I work with, main contractors and subcontractors, will put all of their prelim costs into their rates, which means, say for example, you've got a plasterer, they're doing 2,000 square meters of render, 3,000 square meters of skim, or whatever it may be. Instead of having their rates and it be at £25 a square meter, the actual cost of that labour to install that and the materials is one fee. And then what they'll do is they'll add a bit of a markup in it. So their site manager, if they've got to provide any PPE, if their guys are directly employed, so therefore there's employee insurance, PI insurance, you've got their vans, their phone, their holiday pay, the total cost should be all included in that. But that should also include like the project manager, for example. Where people get in difficulties, making sure that when you've got EOTs and delays, which happens all the time, it's not as easy to claim an extension of time, but also it's not as easy to manage your costs, because if your site managers, your project managers, your QSs, contract managers, if you've got them, directors, whether you've got vans, whether you've got facilities on site for, say, welfare facilities, if you've got to supply them, or whether or not you have to supply, say, a lockup for all the guys' materials and tools and things like that. All these things are actually site costs. Now, you might have a site manager. Site managers, generally, they put all the costs associated with them because they are based on site and they only work on that site. But then what happens is you'll have a project manager, and the project manager might be running 2 sites, 3 sites, 4 sites, 5 sites, 10 sites. If they're directly employed, so their car costs, their phone costs, their travel costs, their insurance costs, their employees' insurance, their NI, the whole entire cost should be split over however many projects they're working on. They are a site cost, because they need to look at it as if that job disappears, do those costs disappear? Yes, they do. You've got no projects, you don't need a project manager. So a project manager, even though they're not specific to one project, they should be split out in the prelims. So when I'm looking at prelims, I will say, right, the project manager is going to spend, say, 20% of their time on this project, or it could be 10%, it could be 5%, it could be 50%, depending on how we're going to deliver this project. And it may be the fact that project manager is going to spend 100% of their time for the first 2 weeks, 6 weeks, 10 weeks of the project, depending on the complexities of it. And then they might break off a bit. But ultimately, you have to look at how long is this guy going to spend on this site? And then how long is the project for? And come up with an average, if necessary, of a cost. Or you can, if you want to present it differently, you could have it as a lump sum. But as long as you've got a backup to how you've worked that lump sum out, so that when you are going to look for an extension of time, which happens, and you want to add additional prelims, or when you're going for variations and there's additional costs because your project team, your delivery team are taking longer because of the variation, you need to be able to substantiate it in order to claim. So obviously this goes into more detail in the variation podcast that we've already had, but these are site specific. So when I'm working with companies and they're struggling with cash flow, the first thing I look at is their overheads and what are their overheads running at. The very first thing is I have a look at the percentage of their overheads at their current turnover, because a lot of people don't understand if they're looking at they've got overheads at 8%, 10%, 20%, that is subject to turnover. So if your turnover increases, or more importantly, decreases, that percentage changes. So at £8 million turnover to £10 million turnover, your overheads aren't going to remain at 20%. Yes, you may have increased your overheads because you might have employed additional staff members. If you're operating at 20% overhead on 8 million and all of a sudden you're only doing 7 million, that 20% is much higher. So if you're only adding 20% onto your tender costs, you're losing money. The other really dangerous thing is if you aren't allocating these costs to the job, you aren't actually aware of whether or not your job is making money, and you're making decisions based on the wrong information. So by changing the way that information is presented, which is where I get the biggest transformations and get people on my side as such, is when I actually present the information they have in a different way. So if you've got your overheads of this amount, whatever it is a month, 100 grand a month, 200 grand a month, whatever it may be, £1 million a year, these are your overheads. Directors think there's not much I can do about that. I've got a car. It's in a 3-year contract, can't get rid of that. We could buy a cheaper water supplier, or reduce the amount of coffee we spend, or we could take less work trips, or whatever it may be. Like, you can reduce certain things. But ultimately, because you've got site costs in that same overhead project, a lot of the time you're like, how do we reduce overheads? But actually, there isn't much to reduce. What you need to do is extract the project costs out of that and put them in the projects. Because many times I've spoken to clients and they've got problem projects that are overrun, and it's no fault of theirs. It's because the client hasn't got their ducks in a row, hasn't got their design in time, isn't being managed properly, a number of reasons why the project is delayed. And I go, why are you not asking for an EOT? Oh, because we're making money on them and they're a good client and blah, 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 blah. When they think in their head they're making 20% profit because somebody told them that there was 20% profit on at the very beginning, and they haven't checked that because they haven't looked at it, and somebody doesn't understand the difference between markup and profit, they think they're making loads of money out of this client, so they don't want to rock the boat. When I look at this information and actually present it in a very different way and show them what they're actually making and say, well, this is what the job was supposed to cost. This is what the job is actually costing. Here are the accruals for the purchase orders or whatever else, the contracts and everything you've got coming. Here's the contingencies. Here are your current site costs. Your overheads are actually this percentage. And then you look at the bottom line, and so often they're actually losing money. It's heartbreaking, because I have to tell somebody that thinks they're making 20% profit, which makes them feel good because they're making 20% profit, which is a good level of profit to make, especially on £10 million turnover. I have to tell them they're actually losing 5% on a project. It's a tough message to deliver, but what I always do is I deliver that hard message and then I give them the solution to turn it around and actually physically turn it around for them. And this is where sometimes I have to break people in order for them to come on board and see things the way I'm looking for, and then they're open to change. So it's similar to children or with your relationships. Business is no different. Giving people the right information in order to make the correct decisions is imperative in business. And the question is always, how? How did we get here, and how are you going to fix it? And first of all, I look at how we're going to fix it. So we'll look at the project. Why is it delayed? Where is it delayed? We're then looking at extensions of time. Generally, by this point, one of the leaders, or if not both, there's rarely just one director. You may have one MD or one CEO, but there's rarely one director. There's normally 2, 3, 4, sometimes more. It's quite common that you'll have one that is we need to sort these clients out, they're causing us problems. And there'll be another going, no, they're a good client. Or sometimes they're both the same. They don't always conflict, but it's always, oh, it's a good client. It's a good client because they like them as an individual. There's nothing wrong with that. But they're making decisions from incorrect information. Once I present the same information, the same figures, just in a much more thorough forensic way, it's lightning speed how quickly they go on phone. Literally within minutes of me delivering that message, they're on the phone going, hey, we need to meet up. And then I arm them with different information, and how they manage to do that's fine. But when they realize that they're losing money, they change their perspective instantly. And then what I work through is like, right, okay, we've got this variation wasn't priced properly. We've got that variation wasn't priced properly. And I looked at getting a loss and expense account together, because the quickest way to turn that around is actually getting paid for what you've done. So we have a look at the variations that are done. We have a look at drawings that have been done, and we find out exactly what's going on, when and where, and then doing a loss and expense account, which is what they're entitled to. A loss and expense account is when a subcontractor or a contractor or anyone that's in contract has been delayed because of the client, whether that is the end user client or main contractor, or you're a subcontractor, whoever you are working for. If they have delayed you by not providing information, or because other traders are delayed, or the project's been extended, you are entitled, on certain circumstances, depending on your contract, obviously, you're entitled to a loss and expense. So that is, what has this delay cost you as a business? So one of the reasons why I recommend that my clients put their prelims in separately and list them is because it's much easier to claim a loss and expense, because you know you've got a QS is costing X amount a week, your project manager is costing X amount a week, your site facilities is costing X amount a week, your site supervisor or site manager is costing X amount of weeks. And you can say, right, this is delayed us by 4 weeks, 10 weeks, 25 weeks, whatever it may be. And these are the associated costs. Now, don't get me wrong, there may be other costs included to that loss and expense, but it's much easier to say, well, you've agreed to these costs because this is in our contract. And if they are wrong, so say, for example, there's been a complexity, or because you are delayed, you're working on site with 3 other trades where you should have had the site to yourself, and you've had to increase your level of management, or you've had to increase your storage facilities. And if there's a valid reason for an additional cost, then obviously you just explain that and obviously apply for it. Doesn't necessarily mean it's granted, it just makes it a lot easier. Those rates, as it were, agreed at the contract stage. But there are other costs that might be included in variations. So as I explained when we spoke about variations, like you should be adding your additional costs, so time delay, to your variation account. If you haven't, there's obviously ways around it, but just speak to a professional. We can obviously sort that out. These are the things that people aren't aware of. That's how I get people out of that situation. Now, just because we put a loss and expense account in doesn't necessarily mean we're going to get you back into profit and anywhere near 20%. We need to have a look at your variation account. Now, if you're at final account stage, it makes it very difficult. But if you're in your interim application stage, it may be the fact is that when I look at your variations account, you haven't been applying for your variations properly. Now, I'm pretty sure I've come up with this example before of where people put in day works and they just add their day works, their materials, and they put that in as variation. But actually, if they go back to the rates, whether they're stipulated or not, that can sometimes be far greater. So there's a number of places that we can try and recoup that lost profit or that lost revenue, which you are entitled to. So there's no con in this. It's about what they're entitled to because they haven't done what they're supposed to be doing. It's about damage limitation and getting this company out of this contract, completing the works that they're doing. I don't mean walk away from the contract, but completing their project, getting paid as much as they can to hopefully at least not lose money. But depending on the severity of the situation, it's never guaranteed. I'm also a firm believer of having conversations with the people that you're working with, because if they know that you're in trouble, and the way you deliver that message and being honest with them and saying, look, we can't sustain this, they know it's very, very expensive if you're going bust. And a lot of the time when people are coming to me with these cash flow issues, they are on the verge of liquidation. They just aren't aware of it. The focus at that point, and this works very intensely and very quickly, is finding where everything is at. Where the money's going that shouldn't be. Where are we hemorrhaging money? What can we stop? What holes can we block? Where can we stop the money flow? So that's the thing that we need to stop first. Then we obviously need to make sure that the revenue's coming in. So where we can increase that moving forward, where we need to operate. Have we got any variations anywhere else? What are we looking at? I kind of imagine in my head that the business is like a colander and there's just money flying out of it everywhere. Where can we block that? And then we need to increase the amount of money coming in, but you also need to stop it from leaking out everywhere. So they're the priorities. And then after we've got in a situation where the business isn't about to go bust, and if it's conversations with the likes of HMRC, or whether it's about getting extra funding to get through a short period, we then look at where they got to this stage. And what is so common is the estimating department and the delivery department don't communicate. The amount of times, and I would say it's probably at least 80% of the businesses that I've worked with over the last 20 years, if not more, the delivery department, so the construction people that deliver the project, never actually feed back to the estimating department about how much that job actually cost. People don't know whether they're pricing right in the first place. If they're not pricing right in the first place, and that may be for a number of reasons, so it could be the fact that the estimators don't understand the way that the companies that they're tendering with operate, because a lot of companies will put 10 tons of caveats in there and they'll go in low to win the job, and then they hit you with variations. But unless you're replicating that with your own clients, which a lot of businesses actually don't like doing, then there's an issue. If your caveats from your tendering process aren't replicated with your caveats moving forward with your client, then you've got a gap, because there'll be variations that your subcontractor will be asking for that you're not entitled to claim because you haven't stated that they're not included, or you weren't aware they weren't included, so you've got that issue. If the design has changed considerably from tender stage to delivery stage and no one's checked to see what was part of the tender and what's being delivered and what the cost differences there are, again, that's something that people don't check. But also whether or not there's contingencies, or who you're working with, whether they can deliver or they don't deliver. And there should always be either a lessons learned, which is a term that one of my clients used to do all the time. We used to have meetings on what did we learn on this part of the project, which I think are great. Or some form of feedback, or at least a CVR, which is a cost value reconciliation, which is a document that should be showing this is what we tendered for, this is what the actual costs are, here's the contingencies, here's the variations, this is where the project is, which should be fed back to the estimating team. It's about finding that happy medium. Now, if you allowed for everything that was delivered in your tender process, you probably wouldn't win that many jobs. But there's a way of presenting that information. I worked with somebody probably 5 or 6 years ago now, and he got very frustrated with me because she had been trying to get her point across to her directors that she worked for a couple of years before I came along. And so I listened to what she wanted to do and respected the fact that she knew this company, she knew all the individuals, and she was a very, very good commercial manager. So I took what she was trying to do and what her vision for the company and her department was, and I presented it to the directors in a very different way. It was the same message, but just delivered very differently. And they took it on board and they made the changes that she wanted. Now, she was actually insulted by the entire process because she was frustrated that they listened to me and not her. And because she'd been saying the same thing again and again and again, month after month for 18 months. And then I come in and swoop in one thing and make a change. She was really frustrated with me. I was doing it for her to try and support her, but she didn't see it that way. And I tried to explain to her, it's not about the message, is how you communicate it. And if you're saying the same thing 100 times and nothing's happening, you need to change the way you deliver the message. So I find that a lot in a lot of companies I go in. Somebody will be telling the directors again and again, week after week, and they've lost their mojo, they're depressed, they've got this loyalty, but they're not happy in the business, they've lost their spark because they're just being ignored. And it's not that they're being ignored, they're not being understood, and there's a massive difference. I then try to explain it in a different way, and often it'll be with figures and forensic analysis of their figures and say, look, this is here, this is there, and give examples. And sometimes that's the best way, but it all depends on the individual. Some people like to watch something, they're visual, some need to hear, some need to read. It all depends on a different person. So if you've got someone that doesn't look at figures, and it doesn't matter how you present the figures, if they're not looking at them, it's just a waste of time. Some people like to read things, they don't like to listen. Some people like a video. You've got to learn to communicate in the most effective way to the person you're communicating to. I generally believe as a communicator, it's my responsibility that who I'm communicating to understands me. If they don't, that's on me. So I will find a different way to explain it. So for example, like with my husband's a very visual person. He has to see that I'm upset for him to understand that there's a problem. And working with different people and so many different companies, being freelance for 20 odd years, I got to understand how different people work and how they operate and how they respond. We're not all that different. I can figure out very quickly what kind of person I'm dealing with, how they respond, what they like to do, what they're going to look at. Are they going to read a 20-page report, or are they just going to look at the summary? And sometimes you have two directors and one wants all the details, but you know full well the other one's going to get lost. So I'm going to do a synopsis and then I'm going to do the detail for somebody else. And some people just like a phone call or a video chat, or they want to sit in person. There's different ways of getting people in an opt-in level, which is what I'm pretty skilled at. So I will find a way to deliver the message, but it's about understanding what the message is first. Just to recap a little bit, if you are saying that you are making profits, a high percentage, which 20% I think is high, 20%, 8%, 12%, whatever it may be, of a multi-million pound operation, you've got no cash flow, you need to ask yourself why, because that does not make sense. Where is that profit if it's not in your bank? And bearing in mind, the profit is when you take your total sales and you take away all your operating costs and what's left. And by all operating costs, all costs, tax, the whole shebang, that's where your profit is. So if you're making 20% profit of £1 million, £2 million, 8 million, 10 million, 20 million, that profit should be sitting in your bank or on your balance sheet somewhere. Yes, you might have invested it back into the business. Yes, you might have taken it in dividends. All profit is not sitting there, but it should be on your balance sheet somewhere, or your profit and loss. You should know where your figures are at. You should know what your operating profit is, what your baseline profit is, or overhead markup is, and where you want your additional costs. You should know these things. And if you don't, then you need to employ a better accountant, or understand your accountant, or listen maybe to your accountant or your finance team, obviously depending on the size of your business. The other thing is making sure that actually you're aware of where your costs are for extensions of time. Understand that actually the price that you are working under and operating in your contract price, you can actually deliver that for that price. Have you checked to make sure you have a CVR, a cost value reconciliation, so what you're expecting it to cost you, what it's actually costing you, and seeing if you are still making that profit, where your overheads are supposed to be, but where they are. If you've allowed for 18 weeks of a cherry picker, for example, and actually your cherry pickers on site, you haven't got one of them, you've got 3 of them, and they're costing you £600 a week, and they're on 22 weeks or 30 weeks or 50 weeks. Where's that cost? Who's paying for that? Why is that not in your allocation? Where is it sitting? Have you double checked that? Why? Your CVRs should be a working document. So as soon as the cost is updated, they should be there. All the invoices should be issued. They should be in your CVR and reflected. So you know exactly what's coming. Your accrual should be in there. You should know where you're coming and where your costs are. You should have contingency. What's happening with the contingency? Where's it at? What's left? Have we expended that contingency? Do we have any left? Are we overspent the contingency? These are the things that you need to be aware of, where your project's at every moment. And yeah, okay, it takes time to update, but if you've got the right processes in place to have that updated, you should be reviewing these for every single project on a monthly basis. And you should understand where you're at with your business, and your team should be presenting that to you. It's very easy for leaders of businesses to be out there schmoozing clients and going on golf days. But unless you've got a team in place and you know where your business is at, you know where your costs are at, then you're not leading anything. You're just basically business development. And what's the point in developing a business that's failing? And yeah, you sometimes have to look at your figures and it doesn't always look good. And yeah, it can be boring. I don't dispute that. Maybe not for me, but going out, having networking and having that buzz and meeting up with people and talking about business and having these great relationships with people and being social butterflies and stuff is great. But it's only great if actually what you're doing is bringing money into the business and you're actually making money from it. So there's no point in being all extravagant and driving nice cars, because you're going to lose it if you're not covering those costs properly and you aren't aware of them. Also, when you're looking at costs, you use your data properly. It can actually save you money because, for example, if you've got an account with a builder's match, and whichever builder, you've got local ones, smaller ones, you've got the big Travises and the like that are national companies. When you understand what your costs are and how much you're purchasing and what your buying power is, you can go to them and say, hey, we've given you £1 million, £2 million, £10 million, £50 million worth of business over the next 3 years. I want a better rate. See what they say. Save yourself money that way. So if you've got a handle on what your project is costing, and actually, okay, whether it's the fact that your estimating team are getting prices on one thing, but actually when you go to place the order, the price is slightly different because there's no communication, get the estimating team to ring them up and say, hold on a sec, can you price us this? But actually we're being delivered that. And then Tara said, well, actually we've given you X amount of business. We're going to take that business away and find another supplier that will potentially give you a better discount, because there's always someone ready to undercut someone else for your business. So there's lots of ways that you can do it. But ultimately, the only way to make sure that you understand what overhead is and profit is, and that you're actually making the profit, which a lot of my clients that I've had to save have spent the profits way before they've got them, that's just not sustainable. The construction industry is a really scary place to be right now. There are companies going to liquidation left, right and centre. It's scary. And it's scary because people just don't have control of their costs. They don't understand them. They don't understand what their business is. They don't understand where the money's going, where it's coming from, and how to change it. And they don't understand how to get from A to B because they're making decisions on the wrong information. The other thing that a lot of construction companies do, and I've spoken to recruiters on this on numerous occasions that have asked for advice on how to help, construction companies don't value, a lot of them, this is very generalized obviously, a lot of construction companies don't value a good finance team. But also on the construction company's defense, a lot of finance teams don't understand construction, and they come into a construction company, they just don't understand how it works. And you cannot be successful in a construction company, in the finance team, if you don't understand how the system works, if you don't understand that payments have to be made on that date. And there is no other reason to do that. And you will open yourself up to adjudication if you don't do it. Payless notices need to be done. It should be the surveyor's job, but if the accounts team can't operate, they're not doing it properly. Cash flow forecasts are king. Cost updates are king. Keep an idea of what the costs of a project are and what costs should go where. Should be down to the finance team. But if the finance team aren't doing it, then someone needs to be doing it with the business. And a lot of people I've worked with, I've got so much experience working with accounts teams because as a QS, you should be working hand to hand together with the accounts team. And the amount of companies where they don't even talk is just unbelievable. But also it's about accounts teams understanding when somebody needs to be paid, they need to be paid. And if you haven't got the money, you need to find it. Or overvaluing applications and spending the money elsewhere. You should be keeping the costs for that business. And if you're trying to save another business with the cost of another project, that's going to end in disaster. It's a temporary fix only. Robbing Peter to pay Paul is just so rife in the construction industry. And that's what fails it. Lots of time when a company's failing and a project is failing, it's got nothing to do with that project. It's because a project that failed 5 years ago and it's a knock-on effect. So yes, people use factoring and finance, which we're going to discuss in a different podcast, but they don't add whatever the charge for that factoring is. They don't put that in the cost, and therefore they're losing 5% of every invoice. And we can go into that in a bit more detail, but there's a number of reasons around cash. But ultimately, the leader needs to take responsibility for their business. And if they don't have a hold of their finances and understand it, they need to make sure they employ the right people that do, and that they are being given the correct information in the right format to make those decisions properly. And so many companies that I come in and help and turn around because they're in chaos, the director has been making the wrong decisions because they've been given the wrong information. And most of the time it's because they don't actually know how to run a business, because they've just been an entrepreneur in a trade and knew what they were doing. They wanted to do something more and they've worked their way up, and they might not have had the right consultants or the right experts to guide them. And as soon as they're giving that information, so many of them turn it around so quickly. The transformation is instant and it's incredible. It's one of the things that I love about my job, that I can turn these companies around, and literally it's just giving them the right information is all they need and what was missing. And then once they understand, that's it. They can then go for growth and live happily ever after. And it's amazing to watch them succeed and just carry on growing. Not everyone does, not all companies do. Sometimes they don't listen. And after I've turned their business around, got them out of trouble, and then got on my merry way, and then check in every now and again, get ignored, I know full well that they're back to their old tricks. And within 18 months to 2 years, I get a notification they've gone into liquidation, which hurts. It does hurt, but ultimately you can lead a horse to water, you can't make them drink. So cash is king. And if cash is king, why isn't it taking your utmost responsibility and your biggest focus? And when people take their eye off what money they're making and where their cash is, their profit and loss accounts, their balance sheets, etc., when they don't know what that is and know that inside out, they know nothing about their business and they're open for failure.
Extremely valuable advice, Michelle. The phrase knowledge is power comes to mind. If you don't know what's going on in your business, then complacency will set in, and that's when things can go very wrong.
If you found value in today's episode, hit subscribe so you never miss a new release, and share it with someone in the industry who needs to hear it. To learn more, access resources, or find out how Michelle Carr and Construction Alchemy can help you protect your projects, solve problems, and boost your profits, visit constructionalchemy.co.uk. Together, we can change the industry, one project, one company, and one episode at a time. The views and opinions expressed in this podcast are based on the personal experiences of Michelle Carr and her guests. They are for general information only and should not be relied upon as professional or legal advice. Always seek your own independent advice before making decisions. Neither Michelle Carr nor Construction Alchemy accepts liability for any loss, damage, or consequences arising from actions taken based on this podcast. Thank you for listening.